Question 1. Which of the following best describes the main difference between facultative reinsurance and treaty reinsurance? A. Facultative reinsurance is applied to specific risks, while treaty reinsurance covers a portfolio of risks under a broad agreement. B. Facultative reinsurance involves automatic coverage, while treaty reinsurance requires individual negotiation for each risk. C. Facultative reinsurance requires both the ceding company and the reinsurer to agree on each individual risk, whereas treaty reinsurance automatically covers risks under the terms of a standing agreement. D. Facultative reinsurance is more commonly used in Pennsylvania than treaty reinsurance, which is a global reinsurance practice. Answer. C. Explanation. Facultative reinsurance is negotiated for specific individual risks where both the ceding company and the reinsurer must agree on each one. In contrast, treaty reinsurance involves an automatic agreement that covers a portfolio of risks under predetermined conditions. This arrangement doesn't require negotiation for each individual risk as it is predefined in a treaty. This distinction is crucial. Reinsurance companies when determining the appropriate structure for managing risk. Question 2. Mr. Thomas, an insurance underwriter at a Pennsylvania-based insurer, has a growing portfolio of risks related to climate change. His company is considering the use of reinsurance to mitigate its exposure to catastrophic events like floods and wildfires. Given the potential for frequent large-scale claims, which reinsurance option would be most suitable for Thomas to protect against such events? A. Quota share reinsurance. B. Excessive loss reinsurance. C. Stop loss reinsurance. D. Surplus share reinsurance. Answer. B. Explanation. Excessive loss reinsurance would be the most appropriate for Mr. Thomas in this situation because it specifically addresses catastrophic events. It protects the insurer from losses that exceed a certain threshold, which is common for risks like floods or wildfires, where the potential for a single event to cause substantial damage exists. Excessive loss reinsurance is designed to limit an insurer's liability on large unexpected claims by providing coverage only once losses exceed a predetermined limit. This makes it a fitting choice for catastrophic events. Question 3. Which of the following is a key element in determining the appropriate reinsurance pricing model for a ceding company? A. The historical loss data and claims experience related to the types of risks being ceded. B. The geographic location of the reinsurer, which determines premium rates. C. The reinsurance company's capital adequacy ratio, which influences pricing. D. The number of insurance policies in force, which directly impacts pricing models. Answer A. Explanation. Reinsurance pricing is heavily influenced by the historical loss data and claims experience associated with the risks being ceded. Insurers and reinsurers analyze past loss experience to determine the likelihood and potential severity of future claims. This data helps to establish appropriate premium rates and retention limits for reinsurance contracts. While other factors like capital adequacy and policy numbers important, the historical loss experience is the most critical element in pricing reinsurance agreements. Question 4. Which of the following best describes the primary function of retrocession in reinsurance? A. Retrocession allows the ceding company to pass part of the risk back to another reinsurer to reduce exposure. B. Retrocession increases the ceding company's risk retention by removing coverage limits. C. Retrocession allows a reinsurer to pass on part of its risk to the original insurer. D. Retrocession serves as a backup for excessive loss reinsurance coverage in the event of a catastrophic loss. Answer A. Explanation. Retrocession involves a reinsurer transferring part of the risk it has assumed from a ceding company to another reinsurer, which is known as the retrocessionaire. This is done to help the original reinsurer manage its risk exposure and prevent it from being overly burdened by large claims. The goal of retrocession is to spread risk even further in the reinsurance market, thus enhancing financial stability for the original reinsurer. Question 5. Under Pennsylvania reinsurance regulations, which of the following is not a requirement for a reinsurer to be licensed in the state? A. The reinsurer must have sufficient capital to meet solvency and financial obligations. B. The reinsurer must demonstrate expertise in underwriting for specific types of risks in Pennsylvania. C. The reinsurer must comply with state reporting and taxation requirements for reinsurance transactions. D. The reinsurer must have a reinsurance treaty in place with at least 5 ceding companies. Answer D. Explanation. While the reinsurer must meet various solvency, capital, and reporting requirements as outlined by Pennsylvania regulations, there is no requirement for a reinsurer to have reinsurance treaties with a specific number of ceding companies. The focus of the state's licensing criteria is on the reinsurer's financial stability and regulatory compliance rather than the number of treaties it holds. Compliance with taxation reporting is also a core requirement for licensing in Pennsylvania. Question 6. Mr. Harris, a claims manager at a Pennsylvania-based insurer, receives a claim under reinsurance agreement with an excessive loss structure. The insurer's losses from a catastrophic event are calculated at $30 million, and the excessive loss reinsurance agreement has a retention limit of $10 million. How much will the reinsurer be responsible for covering? A. $10 million. B. $30 million. C. $20 million. D. $40 million. Answer. C. Explanation. In an excessive loss reinsurance agreement, the reinsurer only covers the losses that exceed the retention limit set by the ceding company. In this case, the total loss is $30 million and the retention limit is $10 million. Therefore, the reinsurer will cover the difference, which is $30 million. $10 million equals $20 million. The ceding company retains the first $10 million and the reinsurer covers the rest up to the agreed upon limits in the contract. Question 7. Which of the following is the primary purpose of a treaty reinsurance agreement? A. To provide reinsurance on a specific risk-by-risk basis, with each risk requiring separate approval from the reinsurer. B. To establish an automatic arrangement where a reinsurer agrees to cover a portfolio of risks without needing individual approval for each one. C. To allocate risk exclusively for catastrophic events, with the reinsurer only providing coverage for major losses. D. To offer higher retention limits to the company in exchange for lower premiums. Answer. B. Explanation. A treaty reinsurance agreement is a long-term arrangement where a reinsurer agrees to automatically cover a portfolio of risks or types of risks that are ceded by the insurer. Unlike facultative reinsurance, which involves individual approval for each risk, treaty reinsurance covers multiple risks under a single standing agreement. This approach simplifies the process for both the ceding company and the reinsurer, as it avoids the need for case-by-case negotiations. Question 8. Which of the following is typically included in the limits and exclusions clause of a reinsurance contract? A. The maximum amount the reinsurer will pay for claims under the agreement. B. The method used to calculate the premiums owed by the ceding company. C. The reinsurance treaty's duration and termination conditions. D. The underwriting criteria that must be met for risks to be ceded to the reinsurer. Answer A. Explanation. The limits and exclusions of clause in a reinsurance contract defines the maximum coverage that the reinsurer is obligated to provide for any claim and lists any types of risks or losses that are not covered under the agreement. This clause helps establish the financial boundaries of the reinsurer's liability and ensures that both parties understand the scope of coverage and potential exclusions. Question 9. A Pennsylvania insurer is considering retrocession as part of its reinsurance strategy. Which of the following is a potential advantage of retrocession for the reinsurer? A. It allows the reinsurer to increase its retained risk and exposure. B. It enables the reinsurer to reduce its own risk exposure by transferring a portion of the assumed risk to another reinsurer. C. It ensures the reinsurer can increase its premiums for the ceding company. D. It improves the reinsurer's ability to meet the regulatory capital requirements of the ceding company. Correct answer. B. Explanation. Retrocession provides the reinsurer with a way to manage and reduce its own risk exposure by transferring part of the risk it has assumed from the ceding company to another reinsurer. This practice helps to spread the risk further within the reinsurance market, providing financial protection for the retrocedent and allowing it to maintain adequate solvency and financial stability. By transferring risk retrocession, reinsurers limit their exposure to catastrophic losses. Question 10. Which of the following best describes the concept of risk pooling in reinsurance? A. Risk pooling involves aggregating smaller individual risks into larger portfolios to reduce overall exposure for the ceding company. B. Risk pooling involves providing coverage only for risks that are geographically concentrated in a specific region. C. Risk pooling allows reinsurers to avoid underwriting all types of risks, focusing only on the highest value policies. D. Risk pooling ensures that only the largest insurers eligible for reinsurance coverage based on their premium volume. Answer A. Explanation. Risk pooling is a fundamental concept in reinsurance where individual, smaller risks are aggregated into larger portfolios. This process helps to spread the overall exposure of the ceding company, reducing the impact of any single loss on the insurer. By pooling risks together, reinsurers can manage their exposure more effectively and offer more competitive pricing while ensuring that they have a diversified portfolio. Question 11. Which of the following is the primary difference between facultative reinsurance and treaty reinsurance? A. Facultative reinsurance covers a broad portfolio of risks, while treaty reinsurance is limited to specific risks. B. Facultative reinsurance is arranged on a case-by-case basis, while treaty reinsurance automatically applies to a range of risks. C. Facultative reinsurance allows the reinsurer to reject certain risks, while treaty reinsurance covers all risks accepted by the ceding company. D. Facultative reinsurance used for catastrophic losses, while treaty reinsurance is used for small, individual risks. Answer B. Explanation. Facultative reinsurance is arranged on a case-by-case basis where each individual risk is reviewed and agreed upon by the reinsurer before coverage is provided. In contrast, treaty reinsurance is a standing arrangement where the reinsurer automatically covers certain types or portfolios of risks, typically without the need for individual approval for each risk. This distinction makes facultative reinsurance more flexible but also more administratively intensive compared to treaty reinsurance. Question 12. In Pennsylvania, which of the following is a key responsibility of the insurance department when it comes to reinsurance? A. Regulating the pricing of premiums for ceding companies. B. Monitoring the solvency and financial stability of reinsurers operating in the state. C. Determining the structure of reinsurance agreements for all companies. D. Setting minimum retention limits for reinsurance agreements between insurers and reinsurers. Answer B. Explanation. The Pennsylvania Insurance Department's primary responsibility in the reinsurance sector is to monitor the solvency and financial stability of reinsurers operating within the state. This includes ensuring that reinsurers are financially capable of meeting their obligations, thus protecting the interests of policyholders and the integrity of the reinsurance market. The department does not directly regulate premium pricing or specific terms of reinsurance agreements, but focuses on maintaining financial stability in compliance with regulatory standards. Question 13. Mr. Franklin, a reinsurance broker in Pennsylvania, is advising a client on structuring an excessive loss reinsurance agreement. The agreement includes a retention of $15 million, and the total loss from a catastrophic event is $50 million. Will the reinsurer be responsible for under this agreement? A. $15 million. B. $50 million. C. $35 million. D. $65 million. Answer C. Explanation. In an excessive loss reinsurance agreement, the reinsurer covers losses that exceed the ceding company's retention limit. In this case, the ceding company's retention is $15 million and the total loss from the catastrophic event is $50 million. The reinsurer will cover the difference, which is $50 million. $15 million equals $35 million. This is the amount for which the reinsurer will be responsible. Question 14. Which of the following is true about a quota share reinsurance? A. The ceding company retains a fixed percentage of each risk while the reinsurer assumes a fixed percentage. B. The reinsurer only covers losses above a certain threshold, with the ceding company retaining all losses below that threshold. C. The reinsurer only accepts risks above a specified amount and the ceding company retains the lower amounts. D. The reinsurer and the ceding company share losses based on a predetermined loss ratio varies by risk. Answer A. Explanation. Quota share reinsurance is a form of proportional reinsurance in which the ceding company and the reinsurer share a fixed percentage of both premiums and losses for each risk covered under the agreement. This means that the reinsurer assumes a predetermined percentage of each risk and the ceding company retains the remainder. This method ensures that both the ceding company and the reinsurer are financially aligned on each risk. Question 15. Which of the following is a common exclusion found in many reinsurance contracts? A. Claims related to war or terrorism. B. Claims from natural disasters that occur outside of the ceding company's geographic region. C. Claims involving the death of insured policyholders. D. Claims related to the ceding company's failure to pay premiums. Answer A. Explanation. Many reinsurance contracts contain exclusions for claims related to war or terrorism. These types of losses are often considered too unpredictable and catastrophic for reinsurers to cover, which is why they are commonly excluded from reinsurance agreements. Other exclusions may include losses from certain natural disasters or risks that fall outside the scope of the reinsurance agreement, but war and terrorism exclusions are among the most common. Question 16. Which of the following is the most likely effect of a reinsurer's failure to meet its contractual obligations under a reinsurance agreement? A. The ceding company must absorb all the losses regardless of the terms of the contract. B. The ceding company is legally obligated to honor the claims of policyholders without assistance from the reinsurer. C. The reinsurer's failure may lead to financial penalties imposed by the state insurance department. D. The ceding company may seek legal action to recover any outstanding claims or premiums owed by the reinsurer. Answer D. Explanation. If a reinsurer fails to meet its contractual obligations, the ceding company may take legal action to recover any unpaid claims or premiums owed under the agreement. This is often the next step for the ceding company if the reinsurer defaults, as the ceding company needs to ensure its financial stability and fulfill its obligations to policyholders. State insurance regulators may also intervene, but the primary for the ceding company is to seek legal resolution. Question 17. Which of the following best describes the relationship between a retrocessionaire and a reinsurer? A. The retrocessionaire cedes its own risk to the original insurer. B. The retrocessionaire assumes part of the risk originally transferred to the reinsurer by the ceding company. C. The retrocessionaire guarantees a fixed return on premiums for the reinsurer. D. The retrocessionaire replaces the reinsurer in cases of catastrophic loss. Answer B. Explanation. The retrocessionaire is a reinsurer that assumes a portion of the risk originally transferred from the ceding company to the primary reinsurer. In a retrocession arrangement, the original reinsurer seeks to further manage its risk exposure by passing part of the assumed risk to a retrocessionaire. This helps the original reinsurer manage its liabilities and spread risk further in the reinsurance market. Question 18. In Pennsylvania, which of the following is a requirement for a reinsurer to maintain its license? A. The reinsurer must demonstrate continuous growth in premium revenue. B. The reinsurer must meet minimum capital and surplus requirements set by the state. C. The reinsurer must have a specified number of ceding companies under contract. D. The reinsurer must provide quarterly reports on claims handled by the ceding company. Answer B. Explanation. To maintain its license in Pennsylvania, a reinsurer must meet certain minimum capital and surplus requirements. These requirements ensure that the reinsurer has the financial stability and resources to meet its obligations under the reinsurance agreements. This is a critical part of maintaining solvency and ensuring the integrity of the reinsurance market. Question 19. Which of the following is the key purpose of stop-loss reinsurance arrangements? A. To limit the total amount a ceding company must pay for catastrophic losses during a defined period. B. To reduce the overall risk exposure of the reinsurer by capping the losses it is willing to cover. C. To provide additional coverage for losses that exceed a certain threshold over a given period. D. To ensure that the ceding company retains the first portion of each claim, reducing the reinsurer's exposure. Answer A. Explanation. A stop-loss reinsurance agreement is designed to limit the total amount a ceding company must pay for catastrophic losses over a specific period. This arrangement helps the ceding company manage its overall exposure by providing additional coverage once certain loss thresholds are met. It ensures that the ceding company's financial stability is not significantly impacted by large unexpected losses. Question 20. What is the primary advantage of using proportional reinsurance for a ceding company? A. It allows the ceding company to retain a larger portion of the premiums, improving cash flow. B. It provides the ceding company with coverage for large, high-severity losses that may exceed its capacity. C. It enables the ceding company to transfer a fixed percentage of both premiums and risks to the reinsurer, thereby reducing overall exposure. D. It allows the ceding company to avoid regulatory oversight in certain states. Answer C. Explanation. Proportional reinsurance, such as quoted share reinsurance, allows the ceding company to transfer a fixed percentage of both premiums and risks to the reinsurer. This helps the ceding company reduce its overall exposure while sharing the risk with the reinsurer. In turn, the reinsurer also assumes a portion of the premiums and losses associated with the covered risks. This method is typically used to spread the risk evenly, maintain financial stability for both parties. Question 21. Which of the following best describes a per-risk excessive loss reinsurance agreement? A. The reinsurer covers losses above a specific amount per risk regardless of the total number of claims. B. The reinsurer covers all claims once the ceding company's total loss for the year exceeds specified amount. C. The reinsurer covers losses on proportional basis, sharing premiums and losses with the ceding company. D. The reinsurer covers losses related only to single catastrophic event affecting region. Answer A. Explanation. A per-risk excessive loss reinsurance agreement provides coverage for losses above a specified retention per risk. This type of reinsurance protects the ceding company from large losses on individual risks by transferring excess loss to the reinsurer. The reinsurer covers the amount above the retention for each claim, regardless of the total number of claims. Question 22. In Pennsylvania, which of the following is required for a ceding company when entering into a reinsurance agreement? A. The ceding company must obtain approval from the state's insurance department before finalizing the agreement. B. The ceding company must submit all reinsurance agreements to the state insurance department for periodic audits. C. The ceding company must ensure that the reinsurer is licensed to operate in Pennsylvania. D. The ceding company must inform the state insurance department of the reinsurer's rating before entering into agreement. Answer C. Explanation. In Pennsylvania, as in many states, the ceding company must ensure that the reinsurer is licensed to operate within the state. This ensures that the reinsurer meets regulatory standards and can fulfill its obligations if a claim arises. The ceding company must also ensure that the reinsurer has the financial capacity to handle the risks transferred to them. Question 23. Under what circumstances can a reinsurer terminate a reinsurance agreement? A. If the reinsurer believes the ceding company's business practices are violating state regulations. B. If the ceding company requests the termination regardless of any conditions in the agreement. C. If the total premiums collected by the reinsurer reach specified limit. D. If the ceding company fails to pay reinsurance premiums on time or breaches any terms of the agreement. Answer D. Explanation. A reinsurer can terminate a reinsurance agreement if the ceding company fails to pay premiums on time or breaches any of the terms specified in the agreement. Non-payment or breach of contract terms is a typical cause for termination as the reinsurer's financial interests would be at risk. Question 24. Which of the following is an advantage of using facultative reinsurance for the ceding company? A. The ceding company is required to cede all of its business to the reinsurer. B. The reinsurer can provide coverage for large, unusual risks on a case-by-case basis. C. The ceding company can reduce its operational costs by using facultative reinsurance. D. The reinsurer assumes the full responsibility for the ceding company's entire portfolio of risks. Answer B. Explanation. Facultative reinsurance allows the ceding company to transfer large or unusual risks to the reinsurer on a case-by-case basis. This flexibility allows the ceding company to manage its risk exposure without having to cede all of its business. This arrangement is often used for specific high-value or high-risk policies where a treaty reinsurance agreement may not be appropriate. Question 25. Which type of reinsurance is typically used when the ceding company wants to share a portion of the risk for specific classes of business but retain more control over underwriting? A. Excessive loss reinsurance. B. Quota share reinsurance. C. Facultative reinsurance. D. Retrocession reinsurance. Answer B. Explanation. Quota share reinsurance is used when the ceding company wants to share a fixed percentage of its risk for specific classes of business but retain more control over underwriting. This proportional arrangement allows the ceding company and the reinsurer to share premiums and losses according to an agreed percentage, giving the ceding company flexibility in managing underwriting decisions. Question 26. In Pennsylvania, what is the minimum rating that a reinsurer must have to be eligible to accept reinsurance business from a ceding company AA or higher from a nationally recognized rating agency? B or higher from a nationally recognized rating agency. C or higher from a nationally recognized rating agency. D out from a nationally recognized rating agency. Answer A. Explanation. In Pennsylvania, a reinsurer must have at least an A rating or higher from a nationally recognized rating agency such as a M. Best or Standard & Poor's to be eligible to accept reinsurance business. This ensures that the reinsurer has sufficient financial strength to meet its obligations and support the ceding company's risk transfer. Question 27. Which of the following reinsurance agreements involves the reinsurer providing coverage for losses that exceed a specific amount during a defined period, often used to cover catastrophe risks? A. Per risk excessive loss. B. Catastrophe excessive loss. C. Quota share reinsurance. D. Proportional reinsurance. Answer B. Explanation. A catastrophe excessive loss reinsurance agreement is designed to cover losses that exceed a specified threshold during a defined period, usually related to catastrophic events. This type of reinsurance protects the ceding company from large losses resulting from rare and severe events, such as natural disasters or large-scale accidents, by transferring excess risk to the reinsurer. Question 28. Which of the following statements best describes the role of retrocession in reinsurance? A. Retrocession allows a ceding company to transfer risk to the primary reinsurer. B. Retrocession involves a reinsurer transferring risk to another reinsurer to manage exposure. C. Retrocession is used exclusively for catastrophic events affecting large geographical areas. D. Retrocession is the process of allocating premiums between the ceding company and the reinsurer. Answer B. Explanation. Retrocession is the process by which a reinsurer transfers a portion of the risk it has assumed to another reinsurer, a retrocessionaire. This allows the original reinsurer to manage its risk exposure and protect itself from large losses. Retrocession is a common practice in the reinsurance market, helping to spread risks further. Question 29. Which of the following is a typical feature of a reinsurance contract? A. The reinsurer assumes the full responsibility for all risks covered by the ceding company. B. The reinsurer is not required to follow any state regulations regarding solvency. C. The reinsurer typically has the right to refuse claims under the reinsurance agreement. D. The terms of the reinsurance agreement specify how premiums and losses are to be shared between the ceding company and reinsurer. Answer D. Explanation. A key feature of a reinsurance contract is that it specifies how premiums and losses are to be shared between the ceding company and the reinsurer. This agreement outlines the financial responsibilities of each party and the conditions under which the reinsurer will cover claims or provide compensation. The reinsurer is generally required to follow regulatory standards regarding solvency and typically cannot refuse claims. They are within the scope of the reinsurance agreement. Question 30. What is the main benefit of using treaty reinsurance for a ceding company? A. It provides case-by-case negotiation flexibility. B. It offers protection against a large number of small and frequent claims. C. It allows the ceding company to select individual policies for reinsurance coverage. D. It provides coverage for a broad portfolio of risks without the need for individual negotiations. Answer D. Explanation. The main benefit of treaty reinsurance is that it provides coverage for a broad portfolio of risks without the need for individual negotiations. Under treaty reinsurance, the reinsurer agrees to cover specific types of risks or classes of business that the ceding company submits, making it more efficient than facultative reinsurance, which requires case-by-case negotiations. This approach is beneficial for managing large volumes of risks.